Good afternoon, everybody, and welcome to Living Large Las Vegas. I am your host, Coby Sherlock, and today, back in the lab, our co-host, Mr. Derek Parent. Derek, say hello to everybody.
Hello.
Guys, today we have a special treat for you listeners. We're bringing in somebody that is very special to us, and somebody that's impacted both Derek and my lives. And so today we are bringing on the Executive Vice President of CrossCountry Mortgage, Mr. Russell Hossain.
Mr. Russell Hossain. So Russell is, we've been together for a while, and very special guy, super smart, capital markets guy. So in other words, what that means to the listeners is back end pricing, how mortgage companies sell loans, how we hedge things. But I'd like to bring on Russell now. Hey, Russell, how are you doing, sir?
I'm doing wonderful, and thanks for a great introduction. I mean, listen, first of all, more than the EVP or SVP, whatever it is, my title, it's we're good friends, and I respect both of you guys a lot. Thanks for having me in the call.
Yeah, thanks, Russell.
Well, you're one of those guys that I look up to, right? We talk pretty much daily, but just knowing capital markets and just knowing back end and pricing. So if you could say one major thing that possibly is going to change for 2020, what would it be?
I think the key word that I listen, first of all, I want to make sure this is my opinion, and this is from the experience that I've been around. Talking to a lot of friends who are in Wall Street and who are dealing day to day on the trading side, whether it's mortgage-backed securities, whether it's TBAs. Unless there's a catastrophic things happening right now, for the rest of the year, I think it's a pretty flat situation from a origination standpoint. The front end, if the borrowers are on the fence, I don't think you're going to see a massive rally happening. A 10-year ended up being at 1.9 something today. Some are predicting the 10-year could go up to 2, and north of 2. You may see a little rally, but throughout the year, to answer your question, Derek, I think 2020, you're going to see some rallies, but I don't know if it's going to be like a one-sided rally. I think it's going to be a little up and down like throughout the year, unless again, somebody blows a nuclear bomb somewhere or something happens that major catastrophic situation. Things will obviously be in a different place.
So when you say, when you say the 10-year or the bond, in layman's term, what does that mean for our consumers? Like, why is it so important to look at the 10-year bond?
Great question. You can look at the 10-year bond, but I always tell people 10-year bond and mortgage rates have correlation, but it's not always tied up. It's an indication. Mortgage rates are based on MBS, mortgage-backed securities. So mortgage-backed securities instrument that drives the rate. 10-year bond gives you an idea where it's going. But often enough, the traders or the rates have taken into consideration what's happening in the market. So 10-year may rally, but you may not see a rally on the mortgage side of it because it's been already taken care of by the mortgage securities priced differently. So it has some kind of tie-up, but not all the way. So it's always the same. Just because the 10-year rally doesn't mean that you're going to see a rally on the mortgage rates, but it helps. It has some play to it.
So last month, the interest rates, the Feds come out, they lower rates a little bit. Mortgage-backed securities stayed the same, and so what changed was obviously credit cards, car loans, student loans. Why is it that when the Feds change rates, it does not, when they lower rates or raise rates, why sometimes it does not affect the mortgage-backed security market?
Because often enough, again, talking to the traders out there, the market anticipates these movements. The 10-year is tied probably more closely to the bank sector of it, whether it's equity line, whether it's credit card, whether your checking account interest rates, those are more tied to that versus the mortgage-backed securities are tied from a standpoint differently. So they take the indication. So sometimes there's no correlation one-to-one. There may be some, but not necessarily directly affects what 10-year does. It has a play, but not necessarily all of it. So there's no direct correlation. That's why you will see no reaction sometimes on things.
How many years has it that you've been in the mortgage industry now?
It's funny. I've been in the mortgage business since '92. But a lot of us, I don't know about you or anybody else listening. I didn't go to school to become a mortgage banker. I did typical computer science and marketing and things like that, and then by default I fell in '92 because a friend had a mortgage company and got into it. So I kind of got the opportunity to learn the back end operations. I started out as a closing coordinator, did a little bit of post closing, did a little bit of junior underwriting, and then kind of went into this secondary world and pretty much stuck to it till later in life, kind of switched it from secondary to the front end of the equation. So I have a good aspect. Like I tell everybody that I know enough to be dangerous because I can ask questions, but I don't know all of it a lot good. Secondary, definitely it's my world.
That's one of my favorite lines. I know a little bit about enough things to be dangerous, so I can relate with that. So your background alone, Russell, we've been working one another for about 3 years now, and it's always exciting to hear some of the stuff that you have to say. So what would be one thing that you would want the listeners to know that they're not hearing now in the news or on the street?
Wow, that's a big question. I just feel like that sometimes we forget. I'm gonna take the question and answer it eventually, but I'm gonna start somewhere else. First of all, when people talk to me or anybody, right, they say the consumer asking, "Oh, what is the rate doing? And why are your rate different than this guy's rate?" and things like that. Very common thing, right? Yes. Interest rates are based on securities price. Securities price are given by Fannie Mae, Freddie Mac, Ginnie Mae, which is for FHA. That securities price is same for everybody. So it's kind of like you have the pricing listed out there. People go trade it and they pick up a coupon and they produce that coupon. But the reason pricing is different from different people, first of all, it's margin, it's cost of doing origination, and it's also a thing called servicing value. So Wells Fargo may look at their servicing book and say, this loan or these loans are worth 1 point to me. So I'm going to take the securities price and add that value of 1 point, and that's going to be the price to the consumer for me. And then B of A may have different value. So when you see price differences between lenders, part of it is from that, other part of it is servicing. A mortgage, a bank may have a different cost of fund to originate a loan, so they price it differently. But the actual securities price is universal across the board. To answer your question, so that kind of gives you how pricing gets done, right? If people get confused that there are some pricing that are arbitrary, they're kind of proprietary price. There are those for jumbo portfolio lenders. They look at the tenure, they look at the borrowing power, and they price it accordingly. But when it comes to agency loans, Fannie, Freddie, Ginnie Mae's, those are security price. The servicing value and the margin makes the difference on the pricing for the consumer. To answer your question, if consumers they're listening, what it is, and this is just strictly my opinion. I think if you're on the fence, it's time to get off and get it done for the rest of the year. I really don't see you going to see, again, I don't think there's going to be a big rally for rest of the year. I think rest of the year is kind of flat. If you notice, we went through a refinance boom, a little bit of a refinance boom this year, and people are full. They have a lot of loans they have been buying from behind the scenes, and the market is kind of getting full up to a point that year-end's coming, so they're going to kind of slow down on it. They're not, seeking aggressively to buy. So sometimes the year ends, depending on the market and situation. This year happens to be a good year for mortgage business. You're going to see a slowdown. I do think next year it's going to be not crazy choppy, but I think it's going to have some, those bell curves. It's going to go up and down. It's not going to be choppy up and down. It's going to have that steady up, steady down, steady up. Again, unless some crazy stuff happens in the market. Yeah. No, hey, listen, if I could predict 100%, I would not be talking to you guys.
No, right. No, you wouldn't. It's funny is the bell curve. I always, when in business, I teach this a lot with not only bit through business coaching, but through my team. But when you're on the rise, you always are reinventing yourself. People, when we get to the top of the curve, it's when we think we've made it and we haven't. That's when the fall starts. So, we're always growing, and that's what I love about you is the growth mindset. You said something about jumbo loans, and we're in a market that really doesn't have, I don't want to say a ton, but it's only probably about 3 to 4% of our market. It's not a really big market, but we're very, very, very competitively priced for a mid-sized mortgage bank, I would say. And I know recently we just had an amazing jumbo product, come out to our company. But what are some of the benefits of our jumbo product versus the other stuff out there?
I think the one of the reason we wanted to create this jumbo product was that, if you're a mortgage banker and if you're selling loans, and we know pretty much everybody sells their loans at one given time in life, whether you keep it in the balance sheet for a little longer and then end up selling it, or you sell it immediately. Typically, mortgage bankers kind of sells it right away. What we've noticed, in the market, there's only certain people who are dominating this jumbo product, and we're at their mercy of control. What I mean by that, we have to go through their appraisal process. We have to go through their turn time versus, even though we are making decisions, we have to wait on them to make final decisions. So as the market, 2000, it was like an open market in the jumbo side. You could trade, you can create products, you can go to Wall Street, they'll buy it. Obviously, after the crash, everything kind of went away, dried up, except agency. But that market is coming back now, and it's getting liquid enough that there's a lot of trading going on, a lot of securities happening. So we thought the right opportunity was thinking ahead and create a product that it's our product where we can underwrite in-house, we can make our own decision. We don't have to worry about any end investors to make that decision. And on top of it, we created an element of automated underwriting approval where we have, you can run credit through. Obviously, there's some small overlays of certain minimum threshold that you have to meet, but you can run a non-agency automated underwriting approval and apply it to our jumbo loan. So that's a big benefit. Not that many jumbo product has that. So having an option up to $1 million to do that is there. Plus, on the other part that we also rolled out is that on our traditional jumbo product that we rolled out, it will do 90% loan to value, means you can put 10% down and do the loan at no mortgage insurance.
Yeah.
And it's rate-wise, it's not necessarily the non-QM or a subprime type of rate. It's in between. So you're still going to benefit of not having an MI premium on a monthly basis or yearly basis, but having a loan done in-house in one shot, our matrix, our guidelines. So it's either doing business, having some features that doesn't exist, and us making the ultimate decision on that product.
Absolutely. I love what you said because it doesn't matter, if the rate's 4.5 and or 5 or whatever the rate is, let's say, right? And there's no MI. Sometimes you add the MI, you can have an equivalent rate and it's much higher. So 10% down on that loan size is absolutely huge. Jumbos. It's funny. So just to backtrack a little bit, so the difference between agency, which is Fannie Freddie, and then the non-conforming, which is jumbo, right? I remember not that long ago where I personally was around 80%, probably about 3 years ago, like 80%, FHA business. And my business is completely different now. Today, fast forward, we're about 95% conventional, very, very little govy. And I think it's really due to kind of the niche that we stay in, right? But I can tell you, we just closed a Vietao $1.8 million purchase, so 1.3 loan. And I'll tell you that it was probably the easiest underwriting, the easiest set of guidelines, one of the easier loans that we've done in a while. And I say that because most people, the misconception is, and this happens a lot, like, I'm a first-time home buyer, what do I get? And I'm like, well, if there's not really programs, it would be FHA, but the conventional product is a lot more beneficial, my thoughts are today, than the FHA has been, especially now the FHA, the mortgage insurance, is for the life of the loan.
Right. And I think that's one thing. I think another thing that the Wall Streets are getting really they're getting more liquid. They're doing more securities and they're getting more pricing, and they're also getting involved in agency loans too. Uh, they want to do lower balance. When I mean by lower balance, not like jumbo loans, conventional loans. So the appetite is very healthy. I was at the MBA conference a couple of weeks ago, and this is probably one of the best attended MBA conference in a long time, because our industry has gone through so many up and down. I mean, it was so sad at one point, right? Recession and everything. Everybody's kind of sad, but people feel like they're back in it. They're doing stuff, and I think and industry is a different industry than pre-2006, right? Or whatever it is. It's a different world. People are originating are professionals like you and your team over there. You got to trust those people. I know automation is a big play right now. Everybody, yes, I always tell people that automation is going to be always there, but you will still need people's touch so that they can help you with certain process. It's no different. There was always a car, but nowadays car still drives 200 miles an hour, but that didn't replace other things. You still need people to drive that, there are probably some driverless car coming, but my point is that you have to evolve and move around with the products and pricing and market. So it's definitely getting better in our industry when it comes to liquidity in certain sectors.
I'll tell you, one of the things that I truly miss was the interaction, right? So all my clients used to come in the office, and we used to sit down at the conference room table. We used to sign all 1003s, which is the application, and get everything signed and handshaked and hugs. And now DocuSign came in. So me being a 20-year guy in this industry, not to date myself, I'm only 24. No,
Still not good.
Right, but that's I know the industry has, like you were saying, the industry has changed a little bit. Like we said about the self-driving cars, right? Like, the automation did go away a little bit, but I do miss a little bit the interaction. Like, I used to love when my clients came into the office, and it's not as much like that. So I see what you're saying about the automation. You're one of those high-level guys that I really truly enjoy talking with. But as we wrap this up, Russell, one, you're a man of your word, and you're just an impeccable human being. I followed you over from we went to Pearl to here, and just your vision on kind of what we've built, for our region. But if there's one nugget that we can end this call on, and this is to me, it doesn't matter if it's big or small, but one good nugget that we can maybe clients know, realtors know, future employees know, even just the public. What should they know about why they should own a home?
I always say that the basic things. Sometimes we forget the basics. Why give money to somebody else? This is your equity. This is your house. You're paying rent for somebody else versus it's yours, and you get to build it. You're building equity in your home. It's an asset. That's why, that's one of the most important assets in your life. It's going to always be there. And no matter what happens, stocks goes down, everything goes down. Housing does go down. I get that we have the catastrophe of what happened in 2000 or early 2000, but that's not normal. If you look at the history of the housing, it's been pretty steady. There's a little up and down, which is normal, 5-10%, but not that many crash. And I don't see that happening because our government corrected it, right? Make sure things are in right place. So I think it's important to own that asset. It's the asset that's going to be it's a long-term asset. It's going to be there, and you want to have that asset. Cars go and stocks go up and down. Besides anything else, there's an emotional asset and there's a monetary asset, and house hits both those categories.
Yes.
And it's something you should be proud of.
Yeah. So, so when you're saying the government, so I would agree to, in my state of Nevada, the state did some amazing things here where you have to have the ability to repay back. So we have to actually sign a paper that we've identified income, right? So with that said, stated loans were so big at one point, right, that's what most people were doing for loans, and that really is what drove our economy in Las Vegas to crash because it was a bad housing. Now we're built on a completely different. Our housing market is very strong. Do you see stated loans coming back in any state?
You know what? So they may not call it stated loans. They may call it non-QM, and non-QM is already up there, and it seems like non-QM is getting there. Listen, if you really look back, the stated income, when it came around, it was actually intended for the right reason. The abuse that took it down. So stated income, when it was created, it was for people who have multiple businesses, K1s, and all kinds of cash flows. It's hard to do it like a W-2 borrower. So they came up with a risk-based setup to say, if you stated income, if you have the cash flow, and if you have all these things, it's almost like a business loan, right? We will do it. And then we took it and we abused the system. Our industry in general, I feel like the people took advantage of it, and that was not meant for that reason. Do I think stated income will come back? I think some form or shape, it's already back in certain things. You can do a 12-month bank statement now. It is, to me, a little bit of stated, right? Even though you're looking at the cash flow. But you could do stated provided you validate and make sure we're doing it for the right person. As long as we're not, doing the wrong thing for a customer, as long as you're doing the right thing, and if it's a right setup, yes, sometimes you have a business person who may not be able to show you the W-2 incomes the way they have it. They have up and down on their K1s and things like that. For those people, it may be an okay loan to do because they can get the cash flow business going and they can show it. So I feel like I don't know if you're going to see the no income, no assets, maybe some sort of it. But, I hope we don't go crazy with that because we should learn from our mistakes. And hopefully history won't repeat, but often enough they say history does repeat. But hopefully we're more cautious about this time.
I can, off of that question, I could probably ask you 20 more, but I'm not gonna. Right? I'm not gonna. Well, I've literally have spoken and asked you questions, and I got Coby here, new into the industry. He's just doing an amazing job. He's getting out there. I mean, he's everywhere, and it's unbelievable to see the passion in the youth and stuff in the younger generation that we're bringing into this industry. Because I was once, 25 in this industry, and now it's changed, right? So, Coby, if there's one question that you can ask a couple of old dogs, right? What would it be?
For me, it would be, what keeps you motivated in this industry to be so consistent with the practices that we have in place. So what principles are there for you that keeps you motivated and that keeps you driving through times like Russell mentioned in the early 2000s to where we are this year with a great year? And even if we're approaching a year that's a little choppy, what should I expect and what can I utilize to motivate me to keep crushing through?
There you go, Russell.
I'll go first. Then I had Derek. First of all, listen, you got a great mentor. If you consider him a mentor, that's Derek. He's sitting there. He's a great guy. He knows his business. My first meeting with him was we hit it off right away. I believe in being straight up and tell how it is. Now, there's a way to deliver sometimes, and there's a way to be just a jerk. So don't be that jerk. Deliver it professionally if it's a no. But I think be honest to yourself and do the right thing. And the reason you want to be in this thing is because this is a great industry. This is an industry where you're giving loans to somebody who's going to have a house. I mean, think about that effect. That's one of the most important purchases a customer is doing. Whether they're buying their first home or second home, whatever it is, they're still buying a home. That's the best investment. So that's the motivation, taking care of somebody who's going to get a home. Second, it's a great industry. And third is that stay true to what you are and try to get more from a standpoint that don't just get limited to this is my job and that's all I'm going to do. My biggest pet peeve is that, your job is to know everything, take care of your customer. So if you have to stretch out to find out more and take care of it. So stay true to that and be honest. Yeah. There's no point in not being honest. That applies to any industry.
Yeah.
So
some of the reason why, you know, Coby's even in this room today is because he met you at a holiday party last year when you came out here, and we had a nice dinner at Bouchon's, and, you know, Coby was going into law, and he decided, you know, that he would be great at lending, and, you know, here he is now, you know, just a year after meeting us or meeting you, and I've known him for a long time. But I would say what drives me every day is, you know, a little bit what Russell said. I love the interaction with the clients. I love helping people get in their homes. But, you know, there's always, you know, struggles in every industry. And I love the complexity of mortgages. I love that, how we got into high rise, how we solved the niche here. Like, I you know, it's when I'm not a doctor, I'm not, you know, curing cancer, and those guys are doing an amazing job in the healthcare, you know, industry.
exactly.
But we just created a solution to help retention and home ownership, so those doctors are out there solving, and we can help them with where they go home and sleep at night. Like, they go in the lab and they'll look at research, but then they go to their house, right? Or they go to their high rise. They rest their head. They get rest. So I think of it, you know, as the stuff that we can bring back to the community, but what we can create. Like the Infinity program was an amazing program that's meant to retain and recruit. So it's always the next thing for us. And you know, I love help people, but I would say another thing is just guys like you, Dwayne, Rachel, Jane, like the millennials that are in this business, because eventually, you know, I don't know, you know, I don't have a retirement plan as far as I don't have a number. I want to work till I die. That's just how I am. I'm wired that way. I'm very passionate about what I do. So I don't have a retirement number. I just know that there's other things eventually I'm going to want to do, right? So my motivation every day is life, getting out of bed and just knowing I get to come here and be a part of this amazing team, this company. You know, I get to call Russell daily. We joke around sometimes, but he's a great friend, a great mentor, but just impeccable character and just attention to detail, man of his word. Everything he just described about exactly who he is and what he's done for me. And, you know, I appreciate our friendship. You know, we're just coming up in about 20 minutes. So I just want to say thank you for being on the call today. You're an amazing human being. You're a great friend, an amazing listener, and honestly, a partner that I truly love being around. You inspire me, and I'm grateful that I get to work with you every single day. You know, Coby, the same thing, man. I just keep growing. I would just
listen. I gotta carry Derek around with me whenever I go anywhere from now on. Because I'll just say, "Hey, talk to Derek." First of all, thank you, Derek. Enough said. Don't talk about me, but I appreciate it. And then Coby, I think that night, at Bouchon, we may have some extra bottles of vino. That probably made me convinced you to do something.
Oh man, I know. I probably had a little much that night, but I tell you what, I'm glad I chose to listen to you, and I appreciate the words and the guidance. And I can't preach about how amazing Derek's been for me. And you know,
Exactly.
every day I pick you guys' brains, and it's great to hear all the education. But more importantly, it's great to see, you know, that authentic drive exist right in front of me. It helps me to. That's what inspires me on the daily is the give back and the diversity.
Truly, I don't want to make Derek's head any bigger. But if somebody came to the industry and wanted to know where should we start, they're lucky to have a guy. You're literally lucky to have a guy that you happen to be working for a person who's an expert, knows his stuff, knows the business, and you just happen to fall in. And there'll probably be people don't get that opportunity in this industry. It doesn't happen that often because we're all busy doing stuff. We don't have time sometimes, which isn't true. But for you to be in that timing and the factor where he is, you guys are a great team in Vegas. Derek, appreciate it. Thanks for calling me in. Coby, thanks for doing the stuff you guys do, and good luck.
That was amazing. It's so good to hear, you know, from Russell and what he's up to. And it's amazing to hear you guys, you know, really just chop away at some of the fundamentals in our industry that we don't really get to talk about often. And it's good to hear, you know, his perspective of what's to come. So I'm feeling really blessed to be sitting here, man. This was really cool. This was really cool.
Fist bump.
So guys, I just want to say,
Living large Las Vegas, baby.
That's it, baby. Living large Las Vegas. If you don't have a piece of paper and a pen in your hand writing everything that Russell just shared, go ahead and listen again. I actually can't wait to get out of here and turn this back on to hear about what he had to say. But you guys give us a call, 702-331-8185. Mr. Derek Parent. Man,
Yes,
wow.
sir.
Wow, super grateful.